Hi, and welcome to our channel. My name's Alicia Randall, and I am from Fast Growth Consulting. And today I wanted to introduce financial statements and how to read them. So, if you're a new founder, understanding these documents can be sometimes a bit daunting, but they're really important to make informed business decisions. Okay, so I've mocked up three financial statements. We've got the profit and loss, the balance sheet, and cash flow. So I go through these step by step in a lot of detail in three separate videos, which I'll link above and below as we get to each of them. But I just wanted you to go through it as if, well, you are a founder, so as if you're reading a financial statement and trying to understand the status of the business and the things that you should really just look at rather than going through it in a lot of detail. So the first one is the profit and loss. So this is, also known as a P&L, and it basically shows the business performance over a particular year. So I have just assumed that we're looking at the January P&L for three consecutive years. So thinking about that startup fast growth business. So the first thing you'll notice obviously is that the total revenue in 2024, 25 and 26, the business has grown quite considerably. So this is essentially, the income that you've earned from operations. Off the back of that, you have your direct costs, and you can see that at that very early stage, the cost of sales exceeded the cost of revenue, which can happen when you're just starting out, particularly when things are quite expensive. You don't have that, you're not paying a cheaper cost per unit due to the volume. And so the thing that you're interested in really is your gross margin. So for every pound that dollar that you're earning, how much do you have to spend? How much do you have to give away straight away just to deliver that product or service? And how much do you retain? So in this example, you're obviously making a loss, and then you get to a more reasonable gross margin, the percentage. This percentage varies greatly depending on what industry you're in, so it's worthwhile finding out what is normal within your industry. For example, a tech SaaS may be up to 98%, whereas retail could be as low as 30%. So really consider what that is. And then ideally, the focus for you as a founder is to increase your revenues, but also to keep more of it. So you want to fine tune your cost of sales, whether that's through volume, being more efficient, better conversations with your suppliers, whatever the reason is. You want to improve this margin. You want to keep more of that money. If you're seeing that this percentage is dropping once you're established, it's a concern, and it should be a focus before you focus back on the revenue. Then you have your selling costs. So again, the similar as the cost of sales, these are quite variable depending on revenue, but ideally you want your sales and marketing costs to become more efficient over time. And as a startup, the first thing is you want to get this black, and then the next step is to get this black. This one can sometimes take a couple of years, particularly if you have fundraised and you're throwing lots of cash into sales and marketing. So this one might be red for quite a bit longer than this one, but ideally you want to see that improvement. Then you have your overheads. So as the business is growing, you would expect your fixed costs to grow pretty close to revenue those very early days, but then ideally you want that to improve as well. Similarly with your cost of sales and contribution margins, but actually these ones should become static even quicker. So here you can see that the improvement, the net profit and loss improvement from your first year to the second year, you still be loss making, and then third year finally you get to the black. So Obviously, this is an extreme example. You may find that this is in the red for a few years before you get into the black, but just understanding what the focus is. So these costs, ideally, once you're established, should hardly move year on year. And then these are the ones then you can fine tune and focus on for profitability. So that is the profit and loss. The key metrics here really is your operating profit and loss margins and your profit loss margins, contribution margins, and gross margins. They are the ones that you should really focus on as founder. Okay, so next up is the balance sheet. This is basically what your company owes or owns. So it's a snapshot basically of your financial position and is at any point in time. So if it's a January, generally it's a 31st of January balance sheet. And this is just from the beginning of time to the end of time. So the areas that are really important, obviously being a new startup or scale up, cash is really, really, really important. And making sure that you don't run out of money. Cash flow, we obviously go through that in a lot more detail. The other elements worth focusing on, particularly if you're invoicing, is the size of your trade debtors. So looking at how much they are aging. So if you have trade debtors, it's people that are owing you money, and ideally you want that cash to come in as fast as possible. So if you see this growing, you would want to really find out the details of that. So is it growing just because your your revenue is growing, like in this example, or is it because we're just not collecting cash as it should have, and you've got a lot of old debt in there that could turn bad? And by turning bad, I mean you'll never get the invoice paid. So this is a really important metric. Inventory and prepayments is also one just to look at, particularly if your inventory is getting too high. Either you're not turning over your stock fast enough, or you're buying too much upfront and it's going to cause cash issues. And this is, this probably isn't something that you would focus on massively each month. It's obviously worthwhile understanding, but it's not a key driver for the business. The other area, again, worth looking at is your liabilities. These ones, again, ideally you want them to be relatively stable month on month. This is probably too much of an extreme example, but ideally you want to you don't want this to go too low, because then potentially you're paying your creditors too fast. And you want to take full advantage of the credit terms that are given to you so that you can improve your working capital. These ones are largely just timing. So as long as they are managed, that should be fine. And then your loan, obviously, it gives you what your loan is. So if you're reviewing another company, then maybe these things may be more interesting. Again, if you want to look at balance sheet in more detail, I'll go through that. But this is just the key things to look at when you're reviewing it as a founder. And then obviously in here, it's just showing your shares and your retained earnings. These just tick over month by month. But I would say these two in particular and your working capital is what I would be interested in with the balance sheet. Okay, so cash flow, again, I go through this in a lot of detail in another meeting, but this is probably an area that I would be the most interested in as a founder, spending a lot of time to understand this one. So this is showing where your money's going, essentially. So right at the bottom, you have your opening cash balance. So what was it at the end of December? How much you spent or received within the month, and then your closing balance. So this one you can see I've got 885,143,259 in my balance sheet, 885,143,259. So it's representing your cash. And then here you can see, even though in your P&L you had a loss, and a profit, your cash flow is you had more, you spent more in January, you received more in 2025 and you spent more in 2026. So even though these all match up, they're all related, they're all balanced. This is just demonstrating what you invoiced and what you were invoiced, essentially. Whereas this is what the transactions are going in and out of your bank account. So this is, as I said, very interesting to go through as a founder because you want to know what you're spending your money on. You also want to understand the management of your cash, and that's where it comes in here. So here we're saying, regardless of how much was invoiced in the month, which is in your P&L, how many of the invoices were actually paid. So in here, let's assume everything is invoiced. In here, you invoiced 57,500. That's how much was actually invoiced. But you received less than £8,000 of that, because what we're saying is 57,500 is within that figure. That's the P&L. But you collected less than that. You collected 57,500 minus 8,000. So that is why you've got a negative figure on there. On the flip side, we are saying we invoiced 198,250. We're ignoring VAT, GST, sales tax, just for ease. So we invoiced 198,000, but we actually collected 25,000 pounds more than the 198,000 because we're obviously collecting old debt. And then similarly, this is the same as 2024. We invoiced a certain amount, but we collected 38,000. So if this is constantly negative, this would be a concern for me, and I would want to find out why we're not collecting the debt. These ones just have small movements. There may be, say, a huge upfront payment that goes into prepayments. That is one of the main drivers in here. So as long as anything material, I would want to find out what it is. And then this is the flip side of trade debtors. So this is saying of all the invoices we received in the month, which is in here, how much cash left the business? And we're saying £10,000 left the business over and above what was invoiced in the month. This is the opposite. This is the same as the first one. So again, if this is always negative, I'd want to find out why we're not exceeding or at least meeting the terms of the invoices that are received. These ones, again, similarly to other debtors, there may be a few bits and pieces in there, but if it's got anything material, I would then want to investigate. But in general, it moves up and down depending on how much you spent on credit cards, how much there is on employment variability. So if you've got more staff, you'll see this one go up and down month on month. Your VAT, GST, sales tax would also go within here. So this one you may see a benefit for 2 months and then a big negative because that is when, say, your VAT payment goes out quarterly. Movement on fixed asset purchases. So this is when you've bought something that goes straight onto the balance sheet. So that may be a couple of computers. So this is where you see that visibility, because obviously if you're buying any of these fixed assets, you don't see them in the P&L. So you would see it here in the cash flow. And then this would be, there should be a 500 in there. I've just seen an error. So I would, yeah, obviously this doesn't balance now. But anyway, so this is when you see any amounts coming in from investments, amounts coming in for debt, because here you can see in the balance sheet we've got some debt, and then any amounts that are paid back for the debt that's owing. So if you start repaying this, say in the following month, that wouldn't go through the profit and loss. It will reduce this one, but you would see the cash outflows going in here. And then, as I mentioned, you see then the movement month on month of how everything increased and decreased. So that is the overview of, this is basically how you read your 3 financial statements. I would highly recommend that when you get your financial statements, you see the last couple of months so you can see the movements, and also prior year. It's also useful to see how you've moved year on year, and then obviously budget. So if you're getting a monthly management accounts from your bookkeepers or your finance function, or if you're doing it all yourself and you're just downloading it, say from Zero, these are the things that I would look for when I'm managing my financial statements. Obviously, KPIs tell a lot more than these on their own, but it's quite useful to understand what you're looking for. If you're very brand new and you have just started a business, then here is general ledgers that I would recommend for small businesses. So in Europe, Australia and New Zealand, I would say Xero is probably one of the most popular. MYOB is also quite popular. And then in the US, I've seen QuickBooks being more popular. But these are really great tools, and they can help you manage your finances, your general ledgers. All of these have 3 financial statements built in that you can just download. But ultimately, need to seek professional help, ideally if you're brand new, starting off with a bookkeeper. I have a download for that. So if you're interested in learning more about hiring a bookkeeper, red flags, tasks that they do, and tasks you need to retain in-house, then please click on that link below. But essentially, this is, all of this may seem quite daunting if you're brand new or you've just started with a business. It might seem a bit daunting, but with a little practice, you'll get to the hang of it. So as I mentioned, I'm from Fast Growth Consulting. I'm a fractional CFO, and I am creating videos to help you understand finances and transform your finance function. So if that is you, please hit subscribe, and I'll see you in the next video. Thanks.